In this presentation, we'll take a look at a few different penalties related to federal income tax. For more accounting information and accounting courses, visit our website at accountinginstruction.info. First penalty has to do with the failure to file a tax return. So if we are required to file a tax return and we don't do so, it's our responsibility to file the tax return, or at least that's the perspective of the government and the IRS, and therefore penalties and interest will be applied. The penalties and interest may change over time. The interest rates in particular may change over time, but just be aware that if we don't file in accordance to the deadlines, we could be subject to interest and penalties. So the failure to file tax return penalty is 5% per month or fraction of month, not to exceed 25%. Any income tax returned not filed within 60 days of its due date is subject to a minimum penalty of the lesser of 210 or the amount of tax required on the return. So note that the failure to file penalty is going to be different than the payment penalty. So those are going to be two different things. This is just we didn't file the return, and therefore the penalty is going to be subject based on the filing. Then we have a failure to pay penalty. So note that just because we filed doesn't mean that we've met all our requirements, because the IRS wants their money as we earn it. Meaning, if we're talking about the end of the year, if we just filed our return and paid our taxes at that point in time, the IRS would still think that we paid late. So what they want to do, and as we know, we get the taxes withheld from our paychecks typically during the year. And so just note that the filing isn't the only item that's going to cause penalties. So will the failure to pay. If we didn't pay properly in accordance with what the IRS believes should be the proper payment or the on-time payments. So that could be a penalty of 0.5% per month or fraction of a month, not to exceed 25%. And then we have more serious penalties, including a fraud penalty. And remember, what fraud is an intent to deceive. So we filled out our tax return incorrectly, not in error, but in fraud. So typically that intent is the thing that's going to make it, rather than an error, to be fraud. If that's the case, that's a big deal, and applies to the understatement of tax that is attributed to fraud. This penalty will be. If that's the case, the rate is 75% on the penalty. So the IRS doesn't like fraud. If we have a position that we're not sure, if we make a mistake on the return and we can prove it's a mistake, that would be a different scenario. If we take a position that is controversial and we think that under an audit we could win that position, then that's a position we could take that wouldn't be fraudulent, because we believe that we can win that position. But if it's clearly an intent to deceive on the tax return, then the IRS is going to assess a much, much higher penalty of the 75% in those cases. Then we got erroneous claim for refund or credit. That rate is 20% on the disallowed amount of the claim if the claim for refund or credit of income filed is found to be excessive. So if we have this excessive claim, and again, this is kind of in between this idea of fraud. So this is a lesser step than claiming full fraud here. So we're basically saying, hey, it looks like there was a claim of the refund that was higher or excessive, and therefore, we're not going to call it fraud in this case, possibly, but we think it's serious enough to call it an erroneous claim and assign a pretty hefty penalty of the 20% there. So you want to stay, obviously we want to stay away from any kind of fraudulent claims or intentional claims to deceive on the tax code, only not being scared, on the other hand, to take positions that are defendable. So if we were to get audited, do we have a reasonable case to make in the terms of an audit that we could win in that position is kind of a way that we want to think about it. And if that's true, then even if we're in that gray area, then we may want to go with that position, depending on how much risk aversion our client and we are in that position. If, however, it's a completely we don't believe we would win under an audit, and we don't have a good setting or good grounds for a particular case, then of course that could fall into fraud or erroneous claims, and that could cause problems, including substantial penalty. So not applicable if a fraud or accuracy related penalty has been assessed. So one or the other of these two will be in place. In other words, not both of these items, either one or the other, if either of them are applicable. For more accounting information and accounting courses, visit our website at accountinginstruction.info.